Welcome to Tickmill Weekly Market Outlook for week commencing the 6th of July with me, Patrick Munley. The dollar, like most financial instruments, appears to be going into a consolidation phase, with traders caught between hopes of a recovery and the fears that the US second wave outbreak will turn into something more significant. There also remains much uncertainty over the US employment situation. Despite the strong June non-farm payrolls reading, there are still 31.5 million people claiming unemployment benefit. And a rise in the next weekly jobless claims would certainly pour cold water on the recent optimism. Also note that the US Treasury auctions this week and a chance to gauge whether demand is as strong as usual. Apart from the weekly jobless claims data, I want to pay attention to potentially strong US June ISM services report on Monday, and despite Congress being on a 2-week recess, there will be focus on whether the CARES Act is extended, i.e. whether the $600 per week in extra unemployment benefits gets extended beyond the end of July. So far, the presidential election polling has had little impact on the FX markets. I don't expect that to change really until late August, early September. In short, really, it looks like the summer lull is setting in and we are potentially moving into more range-bound markets. From a technical perspective, if we look at the dollar chart, see here we now have a potential range resistance area at the 97.70. Whilst we trade below there, I anticipate a test of range support down towards this 96.30, 96.50. From there, we may then get the completion of this corrective pattern up into the 98.20, 98.50 area. Certainly be watching that zone very carefully for a bearish daily reversal patterns to set short positions, targeting a move back down towards the 94.60. For the week ahead in the Eurozone, we see the July Syntax confidence reading and May retail sales, both expected to show significant rebounds. Also on the lookout for any updates on the EU recovery funds. European Commission President Charles Michel is expected to propose a compromise plan, primarily to get the Dutch on board, and the proposal may be reviewed at the Eurogroup meeting of finance ministers on Thursday and Friday. Earlier in the week, the European Commission releases updated economic forecasts out on Tuesday. Note, though, that we're seeing significant falling options volatility, which favors again this thesis of more range-bound market, certainly over the week ahead. And there's still a risk that rising US death toll on the back of a fresh wave in cases could prompt a more severe lockdown and a reconnection really between this disconnect of Wall Street and Main Street in the US. From a technical perspective, with respect to the euro dollar, it looks like we have range support here now on 11.80. What I'd be anticipating is a test of range resistance up towards this 113.60 area. From there, looking for the completion of the corrective pattern versus this impulse move, test of 110.90 to 110.50, watching for bullish reversal patterns in this area to set long positions, ultimately looking for a retest of the year-to-date highs at 114.90 en route to an ideal 115.50 test. In the UK, trade negotiations have been showing a little progress, and it's fairly unlikely that there will be change in this stance this week. As the UK-EU trade outlook is the main driver for sterling at the moment, the uncertainty associated with it suggests that there's probably limited upside, certainly over the summer months, with sterling probably going to be the G10 FX underperformer. Rather, the focus this week turns to the summer economic update from Chancellor Rishi Sunak, which is going to be delivered on Wednesday. Tax cuts are probably unlikely, but we should see some targeted measures to cushion the rise in unemployment, such as wage subsidies or firms taking new staff or preserving existing jobs. If there is any meaningful new spending, this may provide a short-term boost to sterling on the day, but its effect should be a one-off and unlikely to last, as the overriding determinant really remains the outlook for the UK-EU trade deal. From a technical perspective, sterling is potentially looking at range resistance here at 125.40. If this holds, I'd be looking for a move back down to 123.25 potential here to set long positions, inverse head and shoulders type scenario for a move back up to test this 126 area before again lower in this broader 126 to 120 range environments. The dollar yen is again also trading in a relatively tight range. One gets the sense that the yen volatility may emerge or may be more likely to emerge in the crosses than in the dollar yen itself. We've got a quiet week ahead. We've seen some focus on the government pension investment fund performance in first quarter of 2020, a $165 billion loss. That's no surprise given a 50% benchmark weighting to equities. But should we expect any political backlash is the question? Probably not. The GPIF has performed very well over the last 20 years with the JGB yields at zero. The GPIF must find a way to make returns for all generations. Thus, you can expect it to maintain its 40% weighting in foreign assets, key channel to recycle Japan's current surplus. In the week ahead, the Japanese calendar sees the May current account surplus expected to widen again, and the Eco Watchers survey for June is also released. We'll also get weekly updates on Japanese foreign bond buying. In terms of domestic debt, there's been some focus on the recent steepening in the JGB yield curve, especially on the 30-year tenor. Any sharper sell-off may see the Bank of Japan further lengthen the maturity of its JGB buying operations. From a technical perspective, it looks like we have some resistance now at this 108. I'd be looking certainly for a test of range support back down to 106. If we fail to find sufficient demand here, then we could actually see the completion of a long-awaited test of the 104.20 area. In Australia, the Reserve Bank of Australia are meeting next week. It's unlikely to yield any material surprise or changes to the policy stance, and therefore should have a limited impact on the Australian dollar. Currency comments could drive reaction. There is a chance that the RBA will want to change its relaxed stance on the relatively strong Aussie dollar. A simple acknowledgement, similar to that of the Reserve Bank of New Zealand, that it's posing a hindrance to the economic recovery might actually be enough to trigger some Aussie losses. However, evidence from the past few meetings suggests the reaction may not be very significant in size, and it's really the Australian dollar is really going to pay more attention to global risk sentiment than the Reserve Bank of Australia at this session. From a technical perspective, as we continue to hold this 68.30, I'm now looking for a move up into the 71.50 area. Again, I'll be watching how we trade there. We've got some divergence in terms of momentum study. Bearish reversal patterns here. I can see us trading back down into testing what I consider to be the range support down towards the 67 level before we could potentially mount another move higher. And that concludes the weekly market outlook for week commencing the 6th of July.